Welcome. Welcome to our First-Time Homebuyer Seminar, sponsored by One Vision Credit Union. I'm glad you're here and you've taken time out of your day to view this seminar, participate in this seminar, and hopefully this will provide you with some helpful information and tools to take with you as you begin this exciting chapter of your lives. First and foremost, let me go ahead and get the housekeeping out of the way and read over this brief legal disclosure. The information presented in this seminar is provided for educational purposes only and does not constitute legal, tax, or financial real estate advice. While every effort is made to ensure accuracy, laws, lending guidelines, program availability, and market conditions are subject to change and may vary based on individual circumstances. By attending this seminar, you acknowledge and agree that the presenters and hosting organization assume no liability for actions taken based on the information provided. Now that that riveting disclosure is out of the way, let me briefly give you first a little introduction to who I am and then where we're headed. So my name is Cole. I am the AVP of Member Services here at One Vision Credit Union. I have been in the credit union industry since 2011, so quite a while, it seems, and love credit unions, enjoy serving our community here. One Vision Credit Union is the oldest born and raised credit union. The oldest credit union started in this community that continues to serve the Southern Indiana and Louisville communities. Where we're headed today. So today we're going to cover some kind of big picture topics to help you begin your journey looking for a home. We'll cover common misconceptions, pre-purchase steps, pre-approval process, understanding credit, and choosing your lender. So we'll go ahead and get started. These are the common misconceptions that I frequently find applicants, home buyers coming to me with. So let's go through these and talk about them together. Misconception number one is that you need to put 20% down. That was true at one time, but it is no longer true. For one thing, most folks nowadays have a hard time coming up with 20% of the cost of a home to put down. So the reality is, if you are a first-time home buyer, your minimum down payment is 3% on a conventional loan. If you're not a first-time home buyer, it's somewhere between 3.5 to 5. There are programs out there that allow you to put 0% down. A USDA loan, for example, or a VA loan if you have background in the military, you can put 0% down. But for most folks, 3% is your required minimum down payment if you are a first-time home buyer. Misconception two is that you can't get a loan if your credit history isn't good. So isn't good, that's a little bit of a subjective term. Generally, if your credit is over 740, I'll say, you'll get the best, most competitive rate. But even if your credit is much lower than that, you are still able to get a loan. The reality is that if your credit is 620 or above, then even if you don't have credit, you can still qualify for a mortgage. 620 or above, your rate might be slightly higher, but you are still able to get pre-qualified, pre-approved. If you have no credit, you can have a family member or a co-borrower come on the application with you, and we can utilize their credit to strengthen that application. Misconception number three, you have to pay all of your other debts first. Pay off all your other loans or debts before applying for a home. The reality is that you can have other debts and still purchase a home. We will talk about debt versus income, the DTI, or debt versus income ratio, later in this seminar. But for now, just understand that you can have other debts, whether it's student loans, maybe a credit card or two, an auto loan, personal loan, and still be qualified for a home. Misconception number four is that you've changed jobs several times so you're not able to buy a house. Part of that is based on the truth that we generally want to see 2 years of consecutive employment history, in the same job or same industry, same line of work. So the reality is you can still qualify. That we do look at your last 24 months of employment, but if you've worked in the same line of work, or if you have been in school, then you can qualify even if you don't have that 2-year job history. So an example would be you've been in college for 4 years, maybe worked a couple of part-time jobs, but you were a full-time student. That was your full-time employment. You can qualify for a home even if you've been on your new job maybe 6 months and you graduated from college 6 months ago. It's still possible for you to be pre-qualified or pre-approved. We would look at your college experience and consider that as employment experience. Or let's say that you worked in the medical field. You worked at one hospital for a year or two, and then you changed to a different hospital. You can still be approved because if you're in the same industry, same type of work, same line of work, then that counts kind of as one consistent history in that same industry. Some pre-purchase steps, some things to consider first. First things first. Probably one of the most common experiences I find with those who come and speak with me about getting pre-approved for a home is that they don't have a spending plan or they don't know where their money goes, right? So that might be my number one recommendation. If you don't have a spending plan or a budget, then you definitely need to have one. Simply put, a budget is a plan. It's an understanding of where your money goes in and out. And there's all shapes and sizes for all different kinds of people and walks of life. I am one of our certified financial coaches. I myself or one of our other financial coaches would be happy to sit down with you and talk about a spending plan if you don't have one. But that might be the number one thing I encourage you to do is make sure that you are following a budget or a spending plan. First, because it's wise, there's wisdom in knowing where your money's going, but also because it helps you to plan. And you definitely need to plan in order to buy a home because it's a big purchase. Establish credit if you don't have a credit score, or pay down those credit cards to help boost your score. We'll talk about that. Review your credit report and save for a down payment. The one thing I'll mention here is that you can get a gift from family members. Let's say that you're not able to save for a down payment, or maybe you're able to save that 1%, but you need a couple extra thousand, to help you with your down payment. You can obtain a gift from family if they're willing to assist you. All right, so talking about that first things first, kind of pre-purchase steps, do create a budget, track where your money goes. One thing that I highly encourage you to do is to make savings a priority. I call that paying yourself first. So try to work up to saving 10% of every paycheck if you can. But if you can't, start somewhere. Start saving 1% of your paycheck, of every paycheck, and begin building that savings account. I always encourage people to start by totaling your monthly expenses, multiply that by 3, and make that your emergency savings goal. That's a pretty widely accepted piece of financial wisdom, is to establish an emergency savings, an emergency fund. One reason is because while you're trying to pay down credit cards or keep from charging up credit cards, having an emergency fund allows you to lean on it when you need new tires or your vehicle breaks down instead of charging it to cards. So I would say even before you start to pay off debt or pay down debt, start saving first and build an emergency fund, those 3 months of expenses before you start paying down credit cards or paying off debt, so that you're able to lean on the savings, the emergency fund, without putting debt back on your credit cards at the same time. Kind of along that line, control your debt. Charge only what you can repay in 1 to 2 months if you can. Pay off those higher interest rate cards first. They're not paying me to say this or to promote them, but there's a free resource out there called PowerPay, powerpay.org, or just Google PowerPay. Again, it is a free resource. We don't partner with them. I'm not being paid by them. We're not sponsored by them. It's just a tool that I use in financial coaching that I have found very helpful when you're trying to come up with a debt repayment plan. It has very, very helpful resources on that website. Try to keep your credit utilization low. This is something that not a lot of people are aware of, but even if you have a credit limit, say of 1,000, if you charge up to your credit card limit, that actually really burdens your credit score. It brings it down. If you can, kind of the sweet spot is to charge no more than you can pay off in 1 to 2 months, and try to keep your month-to-month statement balance at or below 30% of whatever your limit is. So for the sake of an example, and easy math, $1,000 credit card limit, 30% of that would be $300. If you have a $1,000 credit card, if you keep a balance on the card, try to keep no more than a $300 running balance, and that will actually help your credit and not hurt it. Talking about more pre-purchase steps, understanding the costs, again, kind of talking about having a spending plan, knowing what to expect. Let's talk a little bit about your monthly payment. What can you expect with a monthly mortgage payment, that house loan mortgage payment? So every loan, doesn't matter where you go, mortgage or not, has principal and interest. Principal is the actual amount that you are paying back on your loan towards the body of your loan. Interest is, for lack of a better word, the fee that you pay the lender for using their money. And then taxes and insurance on a mortgage, if you put less than 20% down, okay, if you buy a house and you don't put 20% down, again, that's fine as a first-time home buyer, put 3% down. But most lenders will require you to escrow taxes and insurance. What an escrow is essentially a savings account that your mortgage lender opens, and then as part of your monthly payment, collects a portion of your homeowner's insurance and your property taxes, along with your regular payment, that principal and interest. This is sometimes shortened to PITI, principal, interest, taxes, and insurance. You might hear that term PITI thrown around in the lending world, but it's just referring to your loan payment, principal and interest, and then your taxes and insurance that your lender will collect as part of that payment and put into an escrow or a savings account. And then they will pay your property taxes and homeowner's insurance for you. And that's a security blanket for them to make sure that those things are paid. So if you're using a mortgage calculator online or a loan calculator, keep in mind that you will likely, as a first-time buyer, if you're not putting 20% down, also be not just paying principal and interest on what you're borrowing, you'll probably also be paying a part of your property taxes and insurance in there. Remember your down payment, that 3% minimum. Reserves, a lot of lenders like to see what they call reserves, or 1 to 6 months of your monthly housing payment on reserve in a bank or a credit union account, bank or credit union account. So whatever your monthly payment is, if it's $1,000 a month, they might like to see anywhere from 1 to 6 months worth of that payment on reserve or already in a savings account, kind of depending on your credit. Closing costs. So on every mortgage, you will pay closing costs. On average, closing costs are approximately, kind of a ballpark number, 3% of your loan amount. And closing costs refer to things like the appraisal, the title work, the recording fees, things of that nature in order to get the home loan done. Closing costs. Prepaids, you may have to pay those as a first-time home buyer. That's 3 months of your property taxes, your homeowner's insurance up front. Sometimes you may be required to pay your entire first year homeowner's insurance premium up front. So again, Whatever lender you choose, whether it's us or someone else, do ask about prepaids so that you know if you need to be saving for those as well. And then just, utility hookup charges. What is it going to cost to connect electricity and water to your new home? Maybe contact your local electrical utility company or water company and see what it might cost to hook up electricity and water to a new home. How much home can I afford? That is a question that I am frequently asked, and this is a tool that I have found helpful just as a general guideline. This is part of our home buyer guide that you can find on our website, onevisionfcu.org. But on line A, you put in your monthly gross or pre-tax income that can be documented, so you can't use money that is cash or not claimed on your taxes. So you can't use your babysitting money or your lawn mowing money. As great as those sources of income are, if you're not claiming them on taxes, you can't claim them on a mortgage. Total your monthly household income and then multiply it times 0.45 and put that on line B. Add up your total monthly debt payments or loan payments. I would encourage you to include whatever you're saving. Count that as a debt or an obligation to yourself, and put those monthly debt payments on line C. And then line D is just going to be B minus C. All right. And that is going to be kind of the maximum monthly house payment I would encourage you to stick around that or under, including your taxes and insurance. General good rule of thumb, if you're out and about and you don't have this in front of you, try to keep your new mortgage payment at or under 28% of your gross monthly income. Again, depending on who you talk to, there's various opinions on this, how much of a max payment you should shoot for, but these are general guidelines that I would encourage you to consider, especially as you're trying to plan a budget for a mortgage. All right, understanding credit. So credit is your personal and employment history. I like to call it your financial report card, right? You get an A, B, C, or D when it comes to your repayment history. It essentially tells lenders or landlords or even cell phone companies, insurance companies, how trustworthy you are based upon your financial track record. Positive information will stay on your credit forever, but negative information, it varies. Up to 7 years, 7 to 10 years for bankruptcies, but information, depending on what it is, how long it stays on it, depends on what kind of information we're talking about. Again, it's used to measure the likelihood that you will repay a loan, and it was created as an objective assessment of credit risk. It's credit scores. There are 3 bureaus that generate those: Equifax, Experian, TransUnion. Those bureaus, and this idea of a credit score, a credit report, was really created to help lenders have a way, a widely accepted objective measurement against which to discern risk when it comes to lending. So that's what credit's for. Credit scores range anywhere from a no score or an insufficient score, like meaning you don't have enough information yet. You're just getting started maybe, so you don't have a score. From there all the way from 300 to 850 if you do have a score. Kind of 740 or above is where you want to be as far as getting the best rates. You can receive 1 free credit report per year. There are lots of scams out there, so the one website you can trust for this is annualcreditreport.com. That will give you your report, but not an actual score. It will help you see what's on your report to see if you need to dispute anything. Make sure your information on there is accurate. If you've been denied credit, a victim of identity theft, unemployed, you can receive a free credit report in those cases. If you're a member of One Vision, you can get your score and check your score and find ways to improve your score using our free credit score tool, which is part of our home or mobile banking. And if you're not signed up for that, and you are a member, please do give me a call or reach out to us and we can help you get signed up. Ways to dispute, you can go directly through the credit bureaus, again, TransUnion, Experian, or Equifax. You can write them. Most folks these days just go to the website or give them a call, and you can do so electronically. They have 30 days to investigate what you dispute. If they can't verify the information, then they are required to remove it. I do encourage you to review your credit and your credit report before applying for a mortgage to make sure that it is accurate, rather than applying and then having to work backwards and fix things from there. Your credit score is made up of 5 different pieces. The 2 largest pieces of the pie, so to speak, that comprise your score and contribute to your score is your payment history and how much you owe. Your payment history, so that is on-time payments. Every on-time payment you make goes into your payment history, positive payment history, and that helps your score grow. How much you owe, so that's getting back to utilization. For example, if you have a credit card limit of $1,000, are you consistently carrying a high balance on that card? The more you owe, the higher your utilization or how much you're using of your outstanding credit, the lower your score is brought. But the less you utilize, again, in the example of the credit card, the lower you keep your balance, the better your score is. And those are the 2 biggest pieces of the credit pie. The other pieces do impact your score just a little less. So the longer you have accounts open, the more history we have on you. Length of credit history, that's 15%. Other factors, including new accounts or a mix of credit card, vehicle loan, line of credit, again, just kind of a mix of credit that also helps your score as well. And this slide, I won't read over everything, but I put it together just to give you ideas of ways to establish or build credit. Especially nowadays, we are seeing some new, previously considered unorthodox, perhaps, ways of generating credit, but now they are being used to help discern your credit worthiness. That could be rent payments, utility payments, cell phone payments. Ask your cell phone company, for example, if they will report to your credit bureaus, to your credit score. But these are ways that you can help to grow, develop, or better your credit. Pre-approval process. So pre-approval is just a fancy way of saying a formal assessment of your credit, employment, debts, income, spouse's income, assets, what you own, what you have in savings, kind of your whole financial picture. To get pre-qualified, you need to provide the following information. These are things I would say go ahead and make sure you have or you know where they are. Driver's license, make sure it's not expired. Last 2 years W-2s for all employers you have worked for. Last 30 days of pay stubs. Last 2 months of bank statements, all pages. So even if there's a third page that has 1 line on it, make sure you do include that because your lender will ask for all pages. You might be asked for last 2 years of your individual tax returns. If you're self-employed, they definitely will want your business tax returns or 1099s, and your last quarter retirement statement or 401k statement might be something that is requested as well. DTI, that's debt to income ratio, debt versus income. That is something that is very important in the lending world. It is something that is reviewed during your pre-approval process. Some lenders won't approve you unless you keep your DTI, your debt versus income, under 45%. So remember, good rule of thumb is to keep your total mortgage payment under 28% of your income. That's because we know that you have other debts you need to pay, and you don't want to max out your monthly income with your house. You got to leave room for other things. So let me go back to that one more time. When calculating a debt to income ratio, generally what we will do, and you can do this too, is we will total up your monthly debt, usually what we see on your credit report, add up your monthly debts, your monthly payments, and we will divide that by your monthly income, and that will come up with a ratio, with a decimal, with a percentage. Generally, we don't want that number to be higher than 0.45 or 45%. The lower that number is, the better off, the stronger the application is. So if you carry high debt, you run this calculation and you have a high debt to income ratio, one thing you'll want to focus on is paying down your debts prior to applying, or asking for a co-borrower or a joint borrower to come on with their own income and credit to help you. You can use their income to put with your income to reduce that overall DTI. Selecting your lender. So all mortgage lenders are not the same. I do encourage you, get a couple of quotes. If you are a first timer looking for a home, I'm biased. I think credit unions are the best in the business. I love One Vision Credit Union. I'd love to talk with you, but wherever you go, do ask for an estimate of closing costs and fees. Again, all mortgages are not created equal. You will find that some lenders charge much more than others when it comes to fees. So do get a reliable estimate. Get references from friends and family. Talk to your mom or dad, your grandfather, your grandmother, your brother or sister or cousin, or close friend, or someone you trust. Where did they finance? How was their experience? Don't just choose based on the rate. You might choose a mortgage company that has a slightly lower rate than another, but maybe the customer or member experience with them is poor. So you have to ask yourself, what is the trade-off there? I do find that credit unions are often some of the most competitive in the business, but wherever you do end up going, whether you finance here with us or with another lender, don't choose based on the rate alone. Obviously, the rate is very important, but look at the whole picture, the member experience, how trustworthy is your loan officer, how likely are you to go back to them for services in the future? How do they compare on their rates and fees? These are some things to think about. Do watch out for predatory lending tactics. If you are encouraged to lie about your finances, or if someone, you've run the numbers, your budget, kind of your max payment, and if you're being pressured to try to take out a home loan for a higher monthly payment amount than you are comfortable with, let those red flags fly in your mind and run the other way. Just some things to keep in mind as you are talking with lenders. We will never pressure you. Any lender that is trustworthy will never push you to make a decision that is not in your best financial interest. All right, and that brings us kind of to the end of our seminar here. This quote is one that I love from Henry Thoreau. If you've built castles in the air, your work need not be lost. That is where they should be. Now put the foundations under them. So if you have this vision of having a family in a home and making memories, that doesn't need to be just a pipe dream, right? Have those dreams, have your castle in the sky, so to speak. Some of us maybe need to tailor the way those castles look, but as you have those goals, work here and now to put foundations under them. That's the aim of this seminar. That's our goal here at One Vision, is to help you lay those financial foundations here and now so that you can grow and build up to achieve those goals, those castles in the air, as Thoreau says, and get into that first home. Again, my name is Cole. My contact information is here at the bottom. It has been a pleasure and an honor sharing this information with you. I look forward to serving you in the future.